Ladies and gentlemen, good day, and welcome to ESAF Small Finance Bank Limited Q1 FY26 earnings conference call, hosted by MUFG Intime India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star and zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Nidhi Vijayvargi. Thank you, and over to you, ma'am.
Thank you, Avirat. Good morning, ladies and gentlemen. I welcome you all to the earnings conference call of ESAF Small Finance Bank Limited to discuss the Q1 FY26 business performance. Today on the call, we have from the management Mr. K. Paul Thomas, Managing Director and CEO, Mr. Girish CP, CFO, Mr. George K. John, Executive Director, and Mr. Hari Vellore, Executive Vice President for Credit. Before we proceed with this call, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may involve risks and uncertainties. For more details, kindly refer to the investor presentation and other filings that can be found on the company's website. Without further ado, I would like to hand over the call to the management for their opening remarks, and then we will open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Nidhi. Good morning to all. On behalf of ESAF Small Finance Bank, we welcome you to the Q1 FY26 earning call, where we will discuss our business and financial performance. We truly appreciate your unwavering support and the keen interest you have shown in our progress. Joining me today are Mr. George K. John, Executive Director, Mr. Girish CP, EVP and CFO, Mr. Hari Vellore, EVP. I hope you all had a chance to review our quarterly results and investor presentation, which are already available on the stock exchange and our bank's website. At ESAF Small Finance Bank, financial inclusion is not just for our origin. It remains the foundation of our strategy. While we began by serving the underserved, we have since expanded to all customer segments, rural, semi-urban, and urban, offering secured lending and a wide range of banking services for both retail and business customers. Our mission continues to be deeply rooted in social impact, even as we focus on building a diversified, resilient, and scalable business that meets the needs of every segment for the long term. We are steadily expanding our retail business across secured lending, which includes gold loan, mortgage loan, mobility loans, and agriculture loans. Strengthening our loan book and aligning with our long-term strategy for stability and growth. At the same time, we are focused on growing our CASA base and enhancing our digital banking capabilities, enabling us to stay connected with customers and foster long-term relationships. Our strategy is built on balanced growth, delivering sustainable profitability while staying true to our mission of empowering underserved communities. We are scaling our business in a responsible, meaningful way, ensuring that every step forward enhances both shareholder value and social impact. India's macroeconomic momentum, driven by structural reforms, rising formal employment, and rapid digital adoption, is creating unprecedented opportunities for financial inclusion. These shifts are enabling banks like ESAF Small Finance Bank to reach deeper into segments that were historically outside the formal banking network. The banking sector itself is undergoing a significant transformation, with stronger regulations, growing fintech partnerships, and a sharper focus on rural and semi-urban penetration. ESAF SFB is well positioned to capitalize on this environment. We have been strengthening our secured lending portfolio, deepening our deposit base, investing in cutting-edge digital platforms, and driving operational efficiencies, actions that reinforce our growth trajectory and risk resilience. Further, bank has also raised Tier 2 bonds with 6-year maturity amounting to rupees 65 crore during July 2025 to further strengthen the CRAR position. With our deep rural franchise, digital-first approach, and unwavering commitment to responsible banking, ESAF Small Finance Bank is poised to deliver sustainable growth, expand market share, and create long-term value, positioning ourselves as India's most trusted social bank. With this context, I now invite our Executive Director, Mr. George K. John, to take you through the next segment.
Thank you, Paul sir, and good morning, everyone. Let me begin by providing a brief perspective on the broader macroeconomic environment that sets the context of our business performance. In its August 2025 Monetary Policy Committee meeting, Reserve Bank of India maintained the repo rate at 5.50%, the standing deposit facility rate at 5.25%, and the marginal standing facility and the bank rate at 5.75%. CPI inflation for FY 2025-26 is projected at 3.1%, while GDP growth is forecasting to remain steady at 6.5%, supported by resilient domestic demand and the continued government capital expenditure. The RBI stance reflects a caution balance, managing inflationary pressure while nurturing growth. The cumulative 100 basis point rate cuts since February 2025 are still working through the economy, and the revised inflation outlook underscores the focus on macroeconomic stability amid global uncertainties and domestic challenges. Turning to the rural economy, which forms the backbone of our customer base, the Indian Meteorological Department projects above normal rainfall for July at 106% of the long period average, following a 9% surplus in June. This bodes well for Harris soil, reservoirs replenishment, and rabi season preparation. Stronger agricultural output and farm incomes are expected to lift rural sentiment and drive consumption growth in the coming quarters. While the microfinance segment faced headwinds earlier this year, we are beginning to see constructive developments, aided by stronger governance framework, enhanced risk controls, and accelerated digital adoption. On the regulatory front, the RBI decision to lower priority sector lending requirements for small finance banks from 75% to 60% is a welcome development, offering greater portfolio flexibility, improved capital allocation, and enhanced diversification. In parallel, ESAF SFB has fully implemented SRM Guardrails 2.0, which will support the building of a stronger, more resilient loan book. As of early July, overall Indian banks' credit growth stood at 9.8%, while deposit growth remains steady at 10.1%. The modernization in credit growth reflects a sector-wide focus on asset quality, with lenders tightening underwriting standards in response to higher delinquencies in unsecured retail segments. I am pleased to share that in the first quarter of FY 26, ESAF Small Finance Bank made meaningful progress in advancing on strategic priorities with continued focus on quality growth, prudent risk calibration, and operational efficiency. Our performance demonstrates steady momentum across key business segments, even as we maintained a measured approach in our microfinance portfolio in line with evolving market conditions and our disciplined risk management framework. As of 30 June 2025, our total business stood at 42,507 crores compared to 40,551 crores a year ago, reflecting a YoY growth of 4.82%. Adjusting for the impact of technical write-off and NPA sales during the period, the underlying growth in total business was a robust 8.74%. Our microloan book declined from 13,236 crores in Q1 FY25 to 9,095 crores in Q1 FY26, in line with our strategy to de-risk the portfolio. During the quarter, we executed NPA sales of 733.4 crores, comprising NPA pool of 362 and technical write-off of 371, generating total consideration of 73.34 crores. This resulted the net P&L benefit of 45.76 crores for the quarter and a meaningful reduction in gross NPA to 362.43 crores. Gold loans were the standard performer, growing 16% quarter-on-quarter and more than double YOY, reflecting consistent demand from our rural and semi-urban customer base. We are well on track to achieve our long-term goal of increasing the share of secured assets to 70% by March 2027. As of now, secured assets account is 54.09% of our total loan book, up sharply from 32.69% a year ago. This significant shift underscores the success of strategy building a more resilient, high quality and lower risk portfolio. ESAF Small Finance Bank today operates to 788 banking outlets, 1,095 customer service centers, 713 ATMs, and 33 institutional business correspondents across 24 states and 2 union territories, enabling deep penetration in rural and semi-urban markets. While Q1 was seasonally muted, impacted by subdued macro conditions, heavy rains in several states, and continuous stress in the microfinance segment, we expect the economic environment to improve in the second half of the year. Supported by a good monsoon, revival in urban rural demand, the upcoming festival season, RBI rate cuts, and sustained government capital expenditure. The microfinance industry is currently facing huge challenges: asset quality pressure and book degrowth, leading to accelerated provisions and revenue softness. We believe stress levels have likely peaked in Q1, may stabilize in Q2 and show positive traction from Q3. Our microfinance recovery strategy included revamping the group meetings, targeted new customer acquisition, and incentivized delinquent borrower follow-up. We remain fully committed to balancing growth with sustainability and prudent risk management. Our continued shift towards secured lending, coupled with disciplined execution in retail, MSME, and gold loan segments, position us well for consistent and sustainable performance. I am also pleased to share that our QR loan was recognized as the best UPI-based digital payment solution, PayTech, at the ETBFSI FinTech Award 2025, underscoring our ability to innovate and lead in inclusive digital finance. At ESAF SFB, financial inclusion remains at the heart of our business model. Our deep presence, technology-led approach, and commitment to serve the underserved give us a unique and defensive position in the market. Alongside this, we are steadily expanding our retail segment across secured lending, MSME, and other asset products, complemented by a strong CASA and digital banking focus. This balanced growth strategy allows us to diversify our portfolio, strengthen quality assets, and capture opportunities across customer segments. We carry this trust with humility and responsibility, ensuring that every step we take creates values, drive environment, and deliver long-term impact for our customers, communities, and shareholders. With this context, I now invite our EVP and CFO, Mr. Girish CP, to take you through the financial performance.
Thank you, sir. Good morning, everyone. I thank all participants for taking time for joining us on the call. Let me give an overview of the financial performance highlights for Q1 FY26. In Q1 FY26, deposits stood at 22,698 crores, up from 20,887 crore in Q1 FY25, representing an 8.7% YOY increase. As part of our strategic focus on stability, we have consciously reduced our share of bulk deposits. Retail deposits rose to 21,763 crore as on 30th June 25 from 19,230 crore a year ago, making a robust 13.17% YOY growth. The share of retail deposits in total deposits improved further to 93% in FY25 to 96% in Q1 FY26, underscoring the strength and stickiness of our deposit base. CASA balances remained a key pillar of our deposit franchise, reaching 5,628 crore in Q1 FY26 compared to 4,927 crore in Q1 FY25, translating to 14% YOY growth. Gross advances stood at 18,224 crores versus 18,783 crores in Q1 FY25, reflecting our calibrated approach to lending in the current environment. Disbursements for the quarter were 7,694 crores, a sharp 71% YOY growth from 4,503 crores last year, with secured loans forming 90% of total disbursements, aligned with our de-risking and portfolio quality strategy. Net interest income for the quarter was 378 crores compared to 588 crores in Q1 FY25, while net interest margin moderated to 6% from 9.4% last year. This was primarily due to the shift in our loan portfolio mix towards secured assets, reduction in repo rates by RBI, the strategic decision to maintain excess liquidity, controlled loan book growth, and higher delinquencies in the high-yielding microloan portfolio. Even though we have done correction in the deposit rates, the transmission in the rate cuts on liability side will take some more time to materialize in full. The product pricing strategy also being rationalized to reverse the impact of immediate shock in the NIM. Non-interest income rose 68% YOY, supported by treasury gains and PSLC income, despite moderated asset growth. Pre-provisioning operating profit came to 125 crores versus 254 crores in Q1 FY25, impacted by unusual interest reversals and the cost of carrying excess liquidity. On asset quality, as of Q1 FY26, gross NPA stood at 7.5% and net NPA 3.8%, reflecting both the prevailing macroeconomic conditions and other cautious stance on microfinance lending. Importantly, our provision coverage ratio improved to 73.2%, demonstrating our continued focus on strengthening the balance sheet and improving the quality of our loan book. We continue to hold additional provision in the advances book in excess of the minimum levels prescribed by RBI. We remain focused on bringing down both gross and net NPA to more sustainable levels over the next few quarters. This will be driven by enhanced monitoring, proactive collection strategies, and sharper risk management across all lending segments. In parallel, we are taking decisive steps to improve internal efficiency, optimize resource allocation, and reduce operating costs while maintaining the high quality and reliability of our customer services. With the risk environment in the microbanking segment showing early signs of stabilization, and with the strategic actions we have implemented in asset sale, secured loan growth, and portfolio diversification, we are now on a stronger and more resilient footing. We expect to achieve positive ROA by the end of FY26 as operating performance strengthens and provisions normalize. FY26 will be a year of consolidation, one where we target moderate business growth while sharply improving operational metrics and building a robust financial foundation for next phase of expansion. Our approach remains disciplined and forward-looking. We continue to maintain provisioning buffers above regulatory requirements to safeguard against potential stress in vulnerable borrower segments. This reflects our commitment to long-term prudence and responsible banking. Accelerating NPA recoveries remain a top priority in our asset quality roadmap. At the same time, we are expanding our secured lending portfolio, including gold loans, mortgages, MSME, and agri-finance, to rebalance the book towards more stable, profitable segments. We remain fully committed to building a healthy, diversified, and future-ready loan portfolio, one that minimizes risk, serves customer responsibility, and drives sustainable value creation for all stakeholders. Thank you very much, and the floor is open for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Vivek Gupta from Star Investments. Please go ahead.
Yeah, hi. Am I audible?
Yes, yes.
Yeah, thank you for taking my question. So, my first question is, from micro loans, like they still contribute around 46% of the book, but unsecured has degrown. Like, how do you expect microfinance origination to normalize or stay moderated? Like, what underwriting changes have been made for micro assets?
I'll take that question. So let me just clarify the question. First is, having shrunk the micro portfolio, what are the steps we have taken to have more better underwriting? Is that the question that you've asked?
Yes.
Yeah.
Okay. So as you know, it's about more than a year now when the SROs, that is the self-regulatory organizations of the microfinance industry, they had introduced guardrails. And the bank has been fully compliant with these guardrails for more than a year now. The guardrails are basically three aspects. One is that we don't lend more than 2 lakhs of rupees, or the industry doesn't lend more than 2 lakhs of rupees to the same individual. Number two, they should not have more than 3 loans outstanding. Essentially, that also means they can't borrow from more than 3 institutions. So these were the three, and nobody will lend to somebody who has a delinquency elsewhere. So these guardrails have been rigorously enforced, and we are actually seeing the benefits of this. I'll split the portfolio that we have into two, because last year we took over the majority of the microfinance portfolio, and we have been running it directly by bank employees. As you know, we have a BC model also. When we look at the figures for the last 1 year and what we have disbursed in the last 1 year, we see that our collections in that portfolio is close to 98-99% or so. So this shows that the credit quality of the credit underwriting has really worked, and the portfolio is doing well. At the same time, the BC portfolio, there is a bit of a stress. What we have done is, over the last 2 to 3 months, we have, directly started managing, or rather directly intervening where required, to bring up the portfolio quality, and we are able to see good results there. The fact also is that Karnataka, which has been a bit of a issue for the last 1 year or so, we had our portfolio largely in Karnataka was run by BCs, and that has shown a bit of a stress. So largely, I think this is what we have to say about the microfinance portfolio and the underwriting aspect.
Okay. So, I have one more question. Like, could you also break down recent disbursements by product and ticket size band, especially the share of small ticket gold versus the large secured loans? And if you could just provide more, like, how is pricing differentiated by ticket size?
In terms of gold loans?
Yeah, gold and other loans.
Hello?
Yeah.
Were you asking specifically about gold loans?
Yeah, small ticket gold loans versus the large secured loans.
Yeah.
Share of, yeah.
Okay. Roughly, I think about 25% of our loans are small ticket gold loans. And when we say small ticket, it will be about a lakh to 25,000 rupees or so. And if you are asking more from a segment point of view, whether we are lending the gold loan to the microfinance segment, then it is even less. It is more about 10% or so of the portfolio will be to the microfinance segment, if that is the question you wanted to know.
That pretty much answers my question. Thank you.
Thank you, Vivek.
Thank you. The next question is from the line of Raj Patel from RK Securities. Please go ahead.
Yeah, am I audible?
Yes.
So thank you for the opportunity. Just 2 quick questions from my side. So as we can see that the gross non-performing asset moved to 7.5% and the net non-performing asset moved to 3.8%. and the provision coverage ratio is 73.2%. So I just wanted to understand that what portion of recent slippage was related to this legacy vintage versus the new vintage, and which state or products are driving this incremental slippage?
See, primarily the slippages are mainly from the microbanking books, mainly from two states. Karnataka and Tamil Nadu contributed almost 50% of the micro loan slippages. However, the positive thing is that the overall SMA levels are moderating substantially over the last quarters, and that is the comfort which we get on moving forward. The slippages will come down.
Okay. And my last question was, so as we can see that the Kerala still holds a large share of the deposits and the advance. So what are the concentration risks, and how are you trying to de-risk or diversify across the various geographies, which could be in the form of state diversification target or the new urban cities?
Yeah. So, thank you, Raj, for asking. If you read the data, it shows that our incremental growth happens outside Kerala, because especially the Kerala book is mainly on the NRIs, because that's a large chunk of people are in South. So, going forward, our focus and what we're doing as personally is that outside Kerala, bringing the incremental growth. So that the way we can de-risk the concentration. And as I mentioned, it is more on the NRI customers in the South.
But the asset concentration has significantly come down. It has come down to 35%. We are well diversified now. We are present in 25 states. We are expanding in the newer geographies. So the asset building is happening. But on the liability side, the Kerala concentration will continue for some more time because of the NRI deposit base we have originally from Kerala.
Okay, that pretty much answered my question. Thank you.
Thank you. Thank you.
Thank you. The next question is from the line of Varun Mishra from MNS Associates. Please go ahead.
Hi, sir. Yeah, thanks for taking up my question. So, we have seen net interest income declined to 378 crores and the NIM has been falling to 6%. So, could you tell us what are the contributors to the margin compression and which levers, pricing mix, or is there a funding mix? Is this prioritizing to restore this margin?
Yeah, the margin is steadily decreasing over the last couple of quarters, mainly because of 2-3 reasons. One is that the asset mix is undergoing a change from the unsecured book to the more secured book. So that is a strategic decision taken by the bank in the wake of the uncertainties and the delinquencies which we have faced from the last year onwards. Apart from that, we were continuously holding around 3,000 crores of excess liquidity throughout last year, which has moderated to around 2,000 crores as of today. So this will have an impact on net interest margin on the negative. And the recent decrease by RBI on the rates by around 100 basis point, the immediate impact will be on the gold loan book, which is one of the major book as of today. And also the other secured books also, mostly it is linked to the external benchmark related rates. But the fresh loans, we have already corrected the extending loan rates. However, it will take some more time to get the full benefit of it. And also the interest rates on the liability book also we have moderated after the rate cut by RBI. However, the repricing of deposits will be happening over a period of time. So the full impact will be received over a period of 1 to 1.5 years. we have already started getting the benefit on the liability book to some extent during the last quarter, but the major portion will be coming in the coming quarters.
All right, sir. And so, given the strong secured disbursements growth in the Q1, especially in gold, so how do we see the investors think about growth versus margin trade-off for the rest of FY26? Also, we see that the micro lapse has been coming down. Could you throw in some light on that as well?
Yeah, on the margins, definitely there will be an improvement going forward once the slippages comes down and also the fresh disbursements taking up at a moderated rates after the rate cuts, then definitely the NIMs will definitely improve. But how much it will improve, I'm not giving any guidance at this moment.
All right. So last question from my end. We see the PCR has been a bit in the same ballpark of 70 to 80. Also, our GNP and NNP has been rising. So could you throw in some light for this quarter?
Yeah, we were aggressively providing over and above the RBI minimum requirement on the NPA front and maintaining the NPAs at 7% and 3% till last quarter. However, since the moderation of the SMA levels gives us comfort to reduce the excess provisioning. Still, we have got excess provisioning, but we thought that we will allow the NPA levels to breach the levels which we were previously maintaining.
All right, sir. That's all from my end, sir. Thank you.
Thank you. Thank you. Thank you.
Thank you. The next question is from the line of Vritti Vora from SAS Capital. Please go ahead. Ms. Vritti, your line has been unmuted. Please go ahead with the question.
Hello. Thank you for the opportunity. So my question is that given the PCR moved from 61.9% in June 24 to 73.2 in June 25, so what is your comfortable PCR target for FY26 and the expected provision cadence if slippage remains at Q1 run rate?
On the provision coverage ratio, we keep the 70% which is prescribed by RBI also as a benchmark for to be maintained.
Okay. Then my further follow-up question is that CASA grew at rupees 5628 crores and CASA ratio is 24.8%. So what is specific initiatives that drove this increase?
Well, there's two or three things that have been happening. And let me also say at the same time, we have been reducing the rate of interest that we pay on CASA deposits. What we've been doing is, as you know, we have increased our network of branches. And these branches are primarily in semi-urban and rural areas. We've been very aggressive in acquisition. We have found that we are able to provide a service which is relatively cheaper and kind of benchmark to these areas because many other banks have been going in the other direction, maybe raising their minimum deposits or minimum required balances, etc., or other fees and charges. So what we've been able to do is provide a service which is very reasonable in price. At the same time, the quality of the service and the technology is as good as any other bank. And customer acquisition has been going on at a very high rate. This is one part of it. The second part of it is, of course, that we are providing most of the services that other banks do, including, cards. We actually add the credit card, etc. So what we are finding is in these specific areas of interest for us, we are able to provide a very competitive product at a very reasonable price. And this will help us to grow the CASA.
Okay. And my further question is how they are sustainable, the product pricing, the channel, and the customer cohorts?
Sustainable in terms of what pricing? The interest rate?
The initiatives that you are driving for the CASA.
Yeah. It is very much sustainable because if you see, the kind of pricing or the services that are provided by these banks, we provide the same at a much lesser cost. Or price, let me say, not cost, price. So it's very much sustainable from our point of view. The other thing is, in most of these areas, there are still so many parts of the community which are underserved in terms of financial services. So definitely there is a huge market opportunity for us, the kind of services we give.
And otherwise, we will have to depend on bulk deposits, which are normally costlier than this.
Okay. Thank you for.
Thank you.
Yeah.
Thank you. The next question is from the line of Preeti Agarwal from SK Associates. Please go ahead.
Yeah, thank you so much for the opportunity. I would like to know that with the capital adequacy ratio that stands at 22.7% and for Tier 1 it is 18.4%, do you feel that you'll be needing fresh equity or you'll have the need to raise long-term debt to support growth or to shore up buffers if spillages persist?
Yeah, because always banks are capital hungry because we are a growing bank, and for the last 1 year only the business growth was only muted. But going forward, we have got aggressive plans for increasing the asset book, and which requires capital, and we have certain plans, but no concrete decisions have been taken so far.
Okay, understood. And I observed that our company has made provisions of 234 crores in Q1. So how much is specific in microfinance versus other products? And what is the underlying stress bucket that prompted this incremental provisioning?
The provisioning broadly runs into NPA bucket, SMA bucket, and the standard assets. The NPA bucket we have provided in excess of, in all these buckets we have provided in excess of the minimum requirements because this will give strength to the balance sheet, which is a practice which we follow for the last several quarters. So substantially the provisioning is on the unsecured book.
Okay. Understood, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Ashlesh Sonje from Kotak Securities. Please go ahead.
Hi team, good afternoon. First few questions on the gold loan product. Can you share what proportion of your branches today offer this product, and what investments would you have done for the business in terms of sourcing valuers or having safekeeping?
Right. So to start with, 662 branches of ours are offering the gold loan product. So that would be roughly 80% of the network. This is one part of it. Second, we have engaged appraisers or valuers across the system. So the process that we have is, first it is appraised by the external valuer, and then internally also we run a check by our own employees before a gold loan is disbursed or approved, let me put it that way. Third, what we have is, wherever physically we have the space, we have a strong room. The Reserve Bank of India specified, strong rooms. Otherwise, what we have are what is called FBR safes, provided by, these leading manufacturers, let's say Steel Age or Godrej, etc. Which are equally, these are industry standard equipment which are used for storage.
And also as a process step, any loans above 5 lakhs will have a concurrent audit will be happened there. And any new to bank customers, there is a additional check of visiting the customer house and verification will be happened. So those second ones are be undertaken for the gold loan.
Understood, sir. And sir, on the product, can you share what are the tenures that you offer, and what is the effective tenure? Because I understand there might be a lot of prepayments in this product.
There can be. However, if you see our, portfolio generally, the large part of it, 80% or so, is for a 1-year tenor. We do have offerings for 2 months, 3 months, 4 months, etc., but largely they are taken for 1 year. In terms of premature closures, I would say about 15 to 20% of our loans tend to get closed prematurely. Otherwise, they don't. So roughly, this would be the kind of proportion.
Understood. Sir, and just a couple of questions on MFI. Out of your total slippages of 468 crores in this quarter, how much was from MFI? And the sale which you have done to ARC, was that entirely from MFI?
The sale comprises of MFI as well as non-MFI, and the proportion of MFI slippage. One second, I'll come back.
But majority of the slippages are from the microfinance. Also on the ARC sale also majority is from the microfinance book only.
Okay, sir. Thank you. If you can come back with a...
We'll share the exact percentage, especially.
Okay, thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for the day. I now hand the conference over to Ms. Nidhi Vijayvarki for closing comments.
Thank you. I would like to thank the management for taking the time out for this conference call today. And also, thanks to all the participants. If you have any queries, please feel free to connect us. We are MUFG In Time Investor Relations Advisors to ESAF Small Finance Bank Limited. Thank you so much.
Thank you. Thank you all. Thank you.
Thank you. On behalf of ESAF Small Finance Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.